So we'll start off with the first question, and in the first question that we have, Mr. Ingenious, who is registered as an intermediary, fails to enter into an agreement with his client and hence penalized by SEBI under the SEBI Act. Advise Mr. Ingenious as to what are the remedies available to him in the order of SEBI. So in this question, let's look at what is the key points that are asked in this question. Here he has failed to enter into an agreement, and SEBI has penalized them, and he wants to know what are the various remedies that are available. So our answer in this case should address all of the 3 points. The first point is, who is required to give a penalty under the SEBI Act? That is the first thing that we need to answer about. And once they have a penalty or given a notice under this act, what are the options that are available to the intermediary? What are the options that are available to him? How much time limit he has to get back on that particular requirement, on this particular order, and if at all he is not happy with the first level order, within how much time he can go back. So this is the simple questions that are asked here. So I'll straight jump into the answer there. So the first thing is, whenever there is what are the options of remedies is given under section 15B of the SEBI Act. It gives clearly as to what are the ways and means in which you can get remedies, and also it talks about the penalty that is given under this particular section. What is the penalty? Penalty is basically rupees 1 lakh for each day during which such failure continues, or rupees 1 crore, whichever is lesser. So it is basically 1 lakh rupees for each day during which certain failure has to be for continuous failure, as well as 1 crore, whichever is lesser. So now let's take an example. This is continuing for 100 days. For the 100th day, the penalty is going to be 1 crore. If it's below 100 days, the penalty is going to be 1 crore rupees. Above that, it is going to be whichever is going to be lesser. So you need to calculate in such a manner. So in this case, below 100 days, I'll take it based on 1 lakh into number of days. If it's above 100 days, it's going to be 1 crore rupees. So now there are 2 remedies that are available to Mr. Ingenious. What are the 2 remedies that are available? First remedy is, he can appeal to the Securities Appellate Tribunal. So that is the tribunal that is available for placing a remedy. Now, where is this particular remedy given? It is given under section 15T of the SEBI Act. Whereas in the other one, we have section 15B, which gives what are the penalties that are available. In section T, it gives about what is the various appeals that can be made to the Security Appellate Tribunal. Now let's understand what are the, how can you get a order? Now the first thing is, the order can be made by the board, and on or after the commencement of the act. Now the board in this case is the SEBI, which is the board. They can give an order, or it can be by an adjudicating officer under the act, or it can be by IRDA or the Pension Fund Regulatory and Development Authority. It is called Pension Fund and Regulatory and Development Authority, may also come under this particular Security Appellate Tribunal. So basically, this SAT, it is termed as SAT. You can also remember that with SAT term. SAT. So Security Appellate Tribunal, they are the ones who can cover all of these 3. What is it that they can cover? They can cover anything with respect to the order from a board, the order from an adjudicating officer, or from IRDA and the Pension Fund Regulatory Authority. Now, by when can they go back on this particular order? When can they place a request to the SAT? The dates are 45 days from the date on which the order is received from either of these three parties. So how many days? It is 45 days. Most important one, because typically you can get, even if after 45 days, if you want to go, sometimes the SAT might say, you have already passed 45 days. You didn't come back within 45 days. Now, what are you coming back with so much of this thing? So 45 days becomes an important one, and it shall be accompanied by a form as well as a fee. Both of these need to be accompanied when I go back with the request, when I go with the request to the SAT. Now, what the Act also permits is, yes, you can go after 45 days, but after 45 days, if you are going, you should have a sufficient cause for not filing within the period. Let us take an example. The COVID lockdown was there. You could not send a notice. In those cases, 45 days can be waived off by the SAT. So the SAT may entertain an appeal after the said period of 45 days. On receipt of an appeal and hearing both of these, after giving an opportunity of being heard, it will pass an order as it thinks deemed fit, and confirming, modifying, or setting aside an appellate order. So basically, it will hear to both the parties. It will understand what is the facts of the case, and then it will pass the judgment. After passing the judgment, importantly, it shall send a copy of every order made to the board, or the IRDA, or the pension fund, or as the case may be, to the parties to the appeal, to the concerned adjudicating officer. So this is a standard one. Whenever you have a case, wherever there is a appealing authority, the end of the appeal, once the judgment is passed, the order, a copy has to be given to the parties involved into the case, so that everybody knows what to act upon. Now, this thing is, there is a time limit within which SAT has to also close a particular case. It is to dispose of any appeal, at least finally within 6 months from the date of appeal. So now there are two dates that we saw. One is 45 days from the date of receiving an order, you can appeal to the SAT. Now, after it goes for 45 days, within 6 months, SAT will have to close this particular case. Now, what is the second remedy available? Now, always I cannot go to the Supreme Court directly. The first step is I need to go into SAT, place the order, and then I go into SEBI. Now, what does after SAT I can go to the Supreme Court? By when can I go into the Supreme Court? Supreme Court, again, from the date of the order, I have about 60 days from receiving the order. I can go to the Supreme Court, and if at all there is a sufficient and cause for delay, it can allow for another period of 60 days. Overall, max to max, I can go for about 120 days. So 60 days from the date of communicating or receiving the order, the Supreme Court may be satisfied that the appellant was prevented by sufficient cause from filing the appeal within the said period, allow it to be filed within a further period not exceeding 60 days. So 60 plus 60, overall 120 days is what the Supreme Court will allow for hearing. So these are the two remedies available. Now I'll just summarize what we just saw in this entire question. So the first step is that we saw in this question is, we understood what is the penalty that can be coming into this act. Now, if you observed one thing, okay, what we have observed is, in this case of the question, they are not asking you what is the penalty, but what we are trying to tell in the answer is, we are also telling the evaluator saying, I know there is this section through which I can get a notice, and if I get a notice under this section, these are the penalties. Because I have got these penalties, I want to go for an appealing. And what are the appeals that I can go? First step is I have to go to SAT. When can I go to SAT? Within 45 days from going or receiving the order. Who can give me the order? The order can be given by the board, or it can be by the adjudicating officer under the act, or it can be by an order of the IRDA or the pension fund regulatory authority. Now, it can also go beyond 45 days, but it has to have a sufficient cause for it. It will hear both the parties. The order will be given to both the all the parties involved into the case. It can be anyone, whether it is your board, adjudicating officer, IRDA, or the parties to the appeal as well. All of them will receive the court order. Now, they have about 60 days time within which 60 days time within which they can go to the Supreme Court. Supreme Court can further extend another 60 days. Overall period is only 120 days. Now, what does the SAT also have to do is, they have to close their cases expediently within 6 months of receiving the appeal. Going to question number 2. So in question number 2, here is it's from RTP, which is November 2021. Perfect Tires Limited was incorporated in January 2019 and came out with its first IPO in the month of May 2020. The company shares were listed on BSE and NSE after successful completion of the IPO and allotment of equity shares made to the investors. The chairperson of the board of directors is a non-executive director. There are 13 directors, out of which one is a woman director. So how many directors are there? 13 directors are there. Right now, I also have a chairman who is a non-executive director. Importantly, 13 directors are there, out of which one is a woman director. Based on the stated facts in the light of the relevant law, advise on the following issues. Whether after listing of the shares, the total number of directors on the board are 13. So that is something that is fixed, out of which one is a woman director. What shall be the required number of independent directors? So that is the question. What is the required number of independent directors? The most very important, what is the number of independent directors? Now they are also saying, if I have a regular non-executive director, what shall be the required number of independent directors on the board? So now we are very clear in terms of the two questions, the two scenarios that they have given. One scenario is, there are 13 directors. Out of the 13 directors, one is a non-executive director, but they have still gone about giving two different scenarios. The first one being 13 are there total, one is a woman director. What shall be the number of independent directors? In the other scenario is regular non-executive director, what shall be the required number of independent directors in the board in this case? So now I need to answer this in 2 points. I need to say what is the law permitting, what is the law saying in terms of independent directors. First, I need to describe that. Then I need to go about telling in terms of if the law is, what does the law permit when it is having a regular non-executive director. So your answer should first start off with the law legal requirement. What does the SEBI Act say or the regulation say? And then we go about answering that. So in which regulation? It, as per regulation 17 of the SEBI LODR regulation 2015, the composition of the board of directors is listed below. It shall have a combination of optimum combination of executive directors, non-executive directors with at least one woman director, and not less than 50% of the board of directors shall comprise of non-executive directors. Take down this. Shall not be less than 50% of the board directors shall comprise of non-executive directors. Where the chairperson of the board of directors is a non-executive director. Here it's a non-executive director. At least 1/3 of the board of directors shall comprise of independent directors. Where the listed entity does not have a regular non-executive chairperson, at least half of the board of directors shall comprise of independent directors. So in these two scenarios, first scenarios, I have all our executive, non-executive directors, no regular chairperson, 50% will be comprising of non-executive directors. Where the chairperson of the board of directors is a non-executive director, at least 1/3 of the board of directors shall comprise of independent directors. So very, very important. Just make sure you remember these two clauses. Now, where does this particular requirement come? This particular requirement comes in. Regulation 17 of the SEBI LODR regulations 2015. So this is the particular regulation within which this particular requirement comes in. Okay. So now I'm going to the answer. Now there is a big confusion. Let us say I have fraction of fractions coming when I do a division. Let us say 13 into 1/3. I'm sure going to get a number which is 4.33. If I do 13 divided by 2, which is to get the 50%, I'm getting 6.5. So when I do this fractions, how do I manage this situation? In those cases, what the Act says is, well and good. In those cases, if it is a fraction, you round it off to the next digit. Any fractions is rounded off to the next digit. That is what I'm going to cover now. Any fractions in the number should be rounded off to the nearest number, not the smaller number to the next number. So 1/3 of 13 becomes 4.33. Round off to 5. So at least 5 independent directors should be there. So in the case of having a regular non-executive chairperson, at least half of the board of directors shall comprise of the independent directors. So 1/2 was 13, which is into divided by 50%, which will come to 7. So at least 7 independent directors should be there. So these are the two answers that are needed to be given. And first you need to explain what the law says. Then you go about explaining what is the calculation and what should be the suggestions and recommendations from your side. I'll just give 2 minutes for you to quickly take down some notes on the regulatory requirement. This part is the most important one. The other part of the answer is only the other part of the answer is only a computation of this. So I want you all to write this particular one, so that once you write this once, if at all the question comes, you'll be able to remember and write whatever is from the law. Importantly, remember that this is regulation 17 of the SEBI LODR regulations 2015. One of the most important regulations that you can ever think of in the SEBI Act. Under the SEBI Act is LODR regulations. Companies are driven by this. Listed companies literally go through every clause of this to comply with this particular requirement. Even if you take the quarterly reporting requirement, where do you think it comes? It comes in this LODR regulation. When should you give how should be the procedure for a reporting? All of those are something that comes into this LODR regulation. Going to question number 3. Okay, so this is a question from RTP November 2020. Very important question. I see this question coming multiple times in the paper. It is on the audit committee composition. Take it from me. One of the most important committees on the board of directors is this committee called the audit committee, which is having super efficient powers compared to all the other committees. What does this committee do? Typically, this committee is the one that goes through the financial statements, the internal audit reports, the control environment of the company. All of those are something that this committee decides, and the composition of this committee is extremely important for the governance of the board. So the Act clearly defines as to how this composition should be, what kind of people should be there on this board, because obviously there should be enough financial literacy on this particular board, because if I don't have somebody who understands financial statements on this board, then I'm under a big risk, because he's approving something he does not aware or is not understanding. So effectively, this particular law also talks on how is the composition on the audit committee. So now I'll straight get into this question. The composition of the audit committee of MKBTC Limited, an unlisted public company, as on 31st of March 2019, comprised of 7 directors, including 4 independent directors. So if you see broadly from a composition point of view, they look fine. 50% is independent directors, well and good. The majority members of the audit committee has the ability to read and understand the financial statements, but none of them has accounting and related financial management expertise. The company listed its securities in a recognized stock exchange in the month of August 2019. So what are the recognized ones? When you talk about recognized stock exchanges, typically it's your BSE, NSE and all of those. Referring to the regulation of the SEBI listing and disclosure requirements, LODR regulations 2015, decide whether the existing audit committee can continue after listing of its securities. So what are they saying? Right now they have an audit committee where people can read and understand financial statements, but none of them have the expertise. They're having under normal knowledge, but not the expertise. So what does the law say? So the audit committee section is regulation 18 of the SEBI LODR regulations. So previously we saw LODR 15. Now I'm coming to LODR regulation 18. What does it say? It basically says that every listed entity shall constitute a qualified And independent audit committee, which shall have A, minimum 3 directors as members. B, 2 directors of the members of the audit committee shall be independent directors. All the members shall be financial literate, and at least 1 member shall have accounting or related financial management. So what are the 3 ones? Minimum 3 directors. So remember that 2/3 shall be independent directors, and the word that the law uses is they shall be financially literate. That means all of them should be financial literate. At least 1 member shall have accounting and related financial and accounting expertise, because I told you, right, they are the ones who read the financial statements and make head or tail out of it and recommend to the board whether they can approve it or not. That is the level and power at which the audit committee functions. Now let us take another example. The the internal auditors come and say there is a problem in your revenue recognition. Now they can be financially literate. They can understand whether the company is doing well or company is doing bad. All of that is fine. But how will they even know what revenue recognition is, under which accounting standard revenue recognition needs to be followed? How will they even do it? That is why it becomes extremely important that they are financially literate and at least 1 member shall have accounting or related financial management expertise. So now let us look at how it is functioning. The facts of the case is MKBTC Limited is recognized in order to comply with requirements of LODR 2015. The company requires to do the following. One point that I would like to highlight to each of you is, in case you don't remember this regulation 18 and regulation 15 and all of that, bare minimum, you should at least write it is driven under this particular requirement. So this particular regulation drives this requirement. At least that should come into your answer. Otherwise, take it from me, then there is no point of you even understanding this requirement, because you should know the backbone. What is the reason why you are doing it is driven by this law. The company requires to do the following. A, it already has 7 directors. So the first requirement it has met. The second one has 4 directors as independent directors. However, once the company gets listed, at least 2/3 shall be independent directors. They need to change the composition of the audit company once they get listed onto the stock exchange. Then coming to the next point, they shall have the ability to read and understand financial statements, but none of them have financial management expertise. Once the company gets it listed, all the members of the audit committee shall be financially literate. At least 1 member shall have accounting or related financial management expertise. Hence, it is required that the company should appoint at least 1 member in the audit committee who has this expertise. So in view of all of this, the existing audit committee cannot continue after listing of its securities. So I'll just summarize this particular one. What does the law say? It basically says minimum 3 directors as members. 2/3 of members of the audit committee shall be independent directors, and all the members shall be financially literate. 1 member shall have accounting or related financial management expertise. You go to question number 4. In question number 4, SEBI on a complaint of Mr. KJ inquires that Mr. Mehta, a chief executive officer of X company, on the basis of UPSI, unpublished price sensitive information, UPSI is famously used, has been indulged in the trading of securities of that company, examine on the basis of the said finding what action can take against Mr. Mehta under the SEBI Act 1992. UPSI, unpublished price sensitive information, is one of the most dangerous, I would say, dangerous thing that anybody can indulge on into a stock market, given that this particular UPSI can literally damage the markets, literally can take all of the efforts of the innocent shareholders onto a ride. And SEBI has been extremely careful of the UPSI. I'll just spend about 2 minutes here of the recent challenges and all of that has been coming out of the UPSI. It has been extremely challenging for SEBI also to kind of control this UPSI, but unfortunately, SEBI has also not been struggling in the recent times, because nowadays what happens is there is these WhatsApp groups, and you have these SMSs that are sent out to individuals saying, please buy this particular company share and target price is this. Today, I don't even know who is that individual to whom this SMS is sent. I don't even know whether the person sending this is an registered advisor, etc., etc. So much of challenges that is going on in today's times. The only thing that can really stop an individual is to his own moral and ethics, which is something that SEBI has been trying to do a lot around this, bring in so much of regulations, and there is certain additional requirements. I'm not sure how many of you are aware of that. There is a requirement of companies to maintain a structured digital database of when who has access to UPSI, when they have got access to it, etc., etc. So many regulations over the last 2-3 years. Companies are even struggling to understand how to do it, but nevertheless, UPSI has been a difficult challenge amongst all of these. Let's get straight into the question here. Now, what is it that SEBI can take action? What is the penalties that they can cause? Let's understand the law here. So it is coming directly from section 15G of the SEBI Act. Always remember this section, because this is a section that deals with penalty for insider trading. Now, the first part of the Act says is, according to this, if any insider, either on his own behalf or on behalf of any other person, deals in securities of a body corporate on any stock exchange on the basis of any UPSI information, communicates any UPSI to any person with or without his request for such information, except as required in the ordinary course of the business or under the law. So let's little bit break these into smaller points for you to understand this particular section. Now, the first one is, section 15G deals with penalty for insider trading, and according to this, if any insider, either on his own behalf or of behalf of any other person, so it could be he has himself done it, or the chairman or the managing director, or it could be any other person who tells him to deal in the security exchange basis in UPSI, unpublished price sensitive information, or he communicates to a person whether he has placed a request or not, except as required in the ordinary course of the business law. Now, why it gives this is, let us say the company secretary. Company secretary is required to send the statement of financial statements 2-3 days before, or whatever is the days before the board, to all of the board of directors. Now, it cannot be that I catch the company secretary and say you have published on UPSI. It is not that way. That is why if it's in the ordinary course of business and or under any law, it is still fine. But either ways, if not for those, it has to be, it is a UP. What is the penalties for this? There is also one more. Counsels or procures for any other person to deal in any security of any body corporate on the basis of UPSI. Basically, is advising somebody shall be liable to pay a minimum of 10 lakhs, which may extend to about 25 lakh, 25 crore rupees, or 3 times the amount of profits made out of the insider trading. So that's a huge amount. End of the day, what are the profits that you make? You have to make 3 times of that. You have to make a penalty out of it, or up to a minimum or minimum of 10 lakhs, and which may extend to 25 crores, and 3 times of the profits that you make, whichever is higher. All such, the SEBI can, after following the prescribed procedure, impose a penalty on Mr. Mehta. The maximum penalty that SEBI can impose is 25 crores or 3 times the amount of profits made out of the trading, whichever is higher. So basically 25 crores or 3 times the higher of the profit. Don't know in this case how much of profit he has made. So these are the terms that are important on this particular question. So just to summarize, when can you be considered as doing an UPSI? One, he shares either on his own behalf to any other person, whether with on the basis of UPSI, communicates to any person apart from ordinary course of business, counsel or procures for any other person, any body corporate on the basis of UPSI, shall be liable to pay a minimum of 10 lakhs up to up to an amount of 25 crores or 3 times of the profit, whichever is higher. So just quickly take down these points, very important. Don't be surprised if you might even get a question on this. Just given the sensitive nature of this point, I'm sure the examiner will want you to remember this section, not from a difficulty point of view, but more from an ethical standpoint and making you aware of UPSI, given that all of you will be chartered accountants and you would have access to this UPSI information. They would want you to remember what are the penalties and what is the legal implications of UPSI. That is the reason that they may even ask you this question. A lot of these questions that come for you are not because they are so complex or the law says it. There are multiple things that the law says, but these are certain critical points that are tested for you. It more of a recall value, and to remember tomorrow if somebody comes to you for UPSI as well, you kind of remember that point and say, I have to pay 25 crores or 3 times of the profits. Why do I have to do that? That is the level of understanding and nature which they want you to remember at an early stage in your life. That is why they ask you these questions. It is fine. So please take down this. Question number 5, which is from RTP November 2019. Mr. Zubin was adjudged as an insolvent by the adjudicating authority. As of that, a group of complainants have alleged that Mr. Zubin, while rendering of his services in office, may be biased in the performance of his duties. Working in such a state of position by him may be detrimental to the public interest, so should be removed from his office. Advice in the given scenario: the tenability of maintenance of complaint against Mr. Zubin. So Mr. Zubin is a member of SEBI and he's been adjudicated as an insolvent. So now what are the ways in which he can be sent out of the board of directors? So Removal of member of SEBI, Section 6 of the SEBI Act 1992. Use all of these, wherein A, according to Section 6 of the SEBI Act, the central government shall have power to remove a member appointed in the board if he is or at any time has been adjudicated as insolvent. B, is of unsound mind and stands so declared by a competent court, has been convinced of an offence which is in the opinion of central government involves a moral turpitude, has in the opinion of the central government so abused his position so as to render his continuance in office detrimental to the public interest. 4 points. A, is an insolvent, unsound mind, adjudicated as an insolvent, unsound mind, has been convicted of an offense which involves a moral turpitude, and abused his position and rendered his continuance in office as a detrimental this thing to the public interest. So these 4 are the key points when a central government has the power of authority to remove a member from the appointed board. So in this case, one key point is before he is removed, he shall be given a reasonable opportunity of being heard in the matter. In the present case, have alleged a member has been adjudicated as an insolvent. His state of position may be affected and rendering his services biased. This may be unfavorable to public interest and so should be removed from the public office. So here the complainants have approached the central government for removing Mr. Zubin, and if the central government is of the opinion is not competent of rendering his services, the central government may remove Zubin from his office in compliance with the said provision. So here the central government may remove Zubin. So just take down this one. This particular section 6 becomes most important for you to write this answer. So remember this section number 6. What does section number 6 say?